In 1999, the financial world was entering a new age of electronic speed. At the center of this transition was Bernie Madoff. Madoff was a pioneer of electronic market making and the former chairman of NASDAQ. He had spent decades earning the confidence of the financial establishment, making him a magnet for wealthy investors and charitable foundations. But at a Boston investment firm, a quantitative analyst named Harry Markopolos was looking at Madoff through a different lens. Markopolos was a chartered financial analyst and a fraud examiner who understood market mathematics at a level few others did. His boss gave him a task that seemed routine: reverse engineer Madoff's strategy so the firm could replicate his unusually consistent returns. It was a high-stakes contrast, one of the most respected figures on Wall Street being scrutinized by a solitary mathematician with a spreadsheet. Markopolos began by inputting Madoff's reported public returns into his models, looking for the underlying mechanics of the strategy. He expected the work to take weeks. It took 4 hours. The returns Madoff reported were too consistent, too smooth, and too perfectly calibrated to be real. The pattern defied the laws of probability. There was no legitimate investment strategy in existence that could have generated them. Markopolos had found proof of a massive fraud before his first lunch break, but he was about to discover that mathematical certainty means very little when it collides with institutional inertia. This chart compares market volatility against Madoff's reported returns. Between 1993 and 2007, he claimed an essentially unbroken record of profitability. Even the best managers have losing months, yet Madoff reported positive returns 96. Madoff's supposed split-strike conversion strategy required trading massive volumes of S&P 100 index options. Markopolos calculated that the volume Madoff needed exceeded the total amount of those options existing in the global market. He was claiming to trade contracts that weren't there. Furthermore, billions of dollars in active options trading should leave a visible trace in market data. Those trades were simply not there. Madoff had no physical footprint in the markets where he claimed to be a dominant force. These data points left only one logical conclusion: Madoff wasn't investing the money at all. He was running a Ponzi scheme. In 2005, Markopolos sent the SEC a 21-page report titled "The World's Largest Hedge Fund is a Fraud." It laid out 29 specific proofs that Madoff was a criminal. Over 9 years, he submitted his evidence to the Securities and Exchange Commission 5 times. Each time, the agency investigated and found nothing wrong. The investigators were lawyers who focused on registration errors and disclosure forms. They lacked the quantitative expertise to understand the mathematical proof Markopolos was handing them. There was also a social dynamic at play. Madoff was a respected pillar of Wall Street. Investigators were too deferential to his reputation, operating with a prior assumption that a man of his stature couldn't be a fraud. The fraud survived because the people responsible for stopping it couldn't do the math, and wouldn't believe the data if it contradicted a powerful man's pedigree. Bernie Madoff wasn't caught by a regulator. He was stopped by the 2008 financial crisis. As global markets plummeted, investigators demanded their money back. The redemption requests far exceeded the new deposits coming in, breaking the Ponzi structure and forcing the lie to the surface. On December 10, 2008, Madoff confessed to his sons. They contacted lawyers immediately, who reported the fraud to federal authorities the next morning. Madoff was arrested on December 11th. The investigation that followed revealed a $65 billion theft that had run for at least 17 years. The largest fraud in history had finally collapsed under its own mathematical weight, exactly as Harry Markopolos had predicted 9 years earlier. $65 billion, thousands of victims, 17 years of a lie. Retirees lost their life savings, and charitable foundations, like the one founded by Elie Wiesel, saw their entire endowments vanish. Markopolos later testified before Congress, describing the SEC as financially illiterate. He had lived in fear for nearly a decade, knowing a massive crime was happening while the authorities did nothing. The Madoff case proved that the truth doesn't always set us free. Sometimes the truth sits on a regulator's desk for 9 years, waiting for someone with the courage to do the math.